Good morning, everyone. My name is Megan Phillips, and I'm the Business Development Manager for Castle Group in Texas. Thank you for tuning into our webinar. Today, we are talking about the 2025 insurance state of the market. Just a few housekeeping items before we get started. We have muted all the participant devices to eliminate background noise so everyone can hear clearly. Many of the questions submitted during registration will be answered throughout the presentation. Feel free to submit additional questions at any time by navigating to the Q&A option on the toolbar. The Q&A portion of the webinar will begin at approximately 11:45 a.m. We are excited to have Jason Barth and Aaron Stone with Brown & Brown with us today. Jason has been a commercial insurance professional for 14 years. He spent the first part of his career on the carrier side of the business with Philadelphia Insurance Company in their Plano office. As a marketing and sales representative and regional sales manager, he helped grow the region significantly. Jason currently leads the marketing department for Brown & Brown's Dallas office, where he works closely with internal and external clients, as well as insurance carriers to place various lines of coverage. He holds a certified insurance counselor designation and licenses in property and casualty and life and health. Aaron is the National Director of Claims. He works closely with internal and external clients and manages Brown & Brown's team of claim professionals who serve as consultants to the brokerage and marketing teams by identifying exposures and tracking liability trends. Aaron and his team also advise clients and advocate on their behalf in the claims and insurance proceeds recovery process. He has 16 years of experience in the insurance industry working for St. Paul Companies, Travelers, and One Beacon Intact Financial in various claims management capacities. Prior to working in the insurance industry, Aaron was an attorney in private practice for 12 years. Welcome, Jason and Aaron. We're really happy to have you with us today.
Thanks, Megan.
Glad to be here.
Well, good morning, everyone, and thanks for participating. Today, Jason and I are going to be talking about homeowner and condominium associations, insurance considerations, state of the market, and claims. Our agenda is fairly simple and straightforward. I'm going to start talking about insurance considerations. We're going to talk about types of insurance policies that you absolutely should have. And then other policies that would be certainly a nice to have if you have it in your budget to buy them. Jason is then going to talk about the state of the market and certain underwriting considerations that we're seeing right now from carriers and how they are assessing risks and what's driving the current market. And then I'm going to finish up with some specific claims examples to kind of highlight how these policies work and respond to certain claim situations. And as Megan indicated, we'll leave some time at the end for Q&A. So with that, we'll start out with insurance considerations. And, you know, as association boards, you're wearing a lot of different hats. You're doing a lot of different things on behalf of the association. You're making significant decisions that impact the owners, and then also can have an impact on the association itself. And one of the most important things that you do is understanding and figuring out what your insurance needs are and making sure that you've procured appropriate insurance in order to protect not only yourself as board members, but the association itself. And so while there are a number of different insurance policies that various HOAs may consider purchasing, at a minimum, every association should have the following. And the ones that we're going to talk about are a variety of what we call first-party policies. In other words, those are policies that are in place to protect the association itself. And then liability policies. And those are policies that are in place that will protect the association for claims that are being brought by outside entities. So the first and probably most important policy, and probably which is your biggest spend from an insurance perspective, is the master property policy. And this is the policy that's purchased by the association to protect the communal property and shared facilities. It doesn't cover the homeowners, properties themselves, But really it covers common areas such as hallways and elevators, amenities. Oftentimes you'll see pools, tennis courts, etc. And this policy is going to be in place to protect and reimburse you for losses in the event that you have damage to those properties, most typically by weather events and other accidents. Some of the things that you should be considering when you are looking at your master property policy and your insurance needs are: one, should you get it on a replacement cost basis or an actual cash value basis? And this is a really important consideration and something you should be consulting with your insurance broker or agent on, because there is a significant difference between the two. The actual cash value basis will reimburse you for loss, but will take into account depreciation. Okay, so it's not going to, particularly if the buildings or the common areas or the structures that were damaged are older, it will take into effect or take into consideration depreciation. So the reimbursement for the loss that you incurred is not going to get you back to the actual value or the amount it's going to cost you to replace that property today. That's where replacement cost value comes in. And really it with all of the things that are going on with the current economy, with increased cost in materials, labor expenses, things like that, probably your best bet is to look at replacement cost value. It's going to cost more, but it protects you and puts you back in the condition you were immediately prior to the loss event. There is one other type of coverage you can look at too, which is called law and ordinance value, which, particularly if you have older buildings and aren't necessarily up to current codes, if there were to be a significant loss and you had to replace those buildings, not only would that provide you replacement cost value, but would also cover those costs, additional costs that you would incur to bring the property up to current code. The next policy that you absolutely should have is a commercial general liability policy. And this is what I talked about. It's a liability policy. It's going to protect you from claims that are brought against you by outside entities. The most common types of claims that we see that are going to trigger a commercial general liability policy is if somebody comes onto the HOA property as a guest and is injured. So these types of policies are going to provide protection for you in the event a claim is brought against you claiming bodily injury or property damage due to the negligence of the association. Another important part or aspect of coverage under a CGL policy is what's called personal and advertising injury. And the significant part of that coverage is it applies to defamation claims. So sometimes you could have a situation where an outside entity is claiming the HOA made a defamatory statement about them, and they bring a lawsuit against the HOA for that. That type of coverage, it's called coverage B, would apply and provide protection to the HOA in that instance. Another policy that coincides with the commercial general liability policy is an umbrella policy. And think of it, as an umbrella. It sits above the commercial general liability policy and just provides additional limits of insurance. So it's an excess policy. And really, most commercial general liability policies, you're going to get limits of 1 million or 2 million per occurrence. And maybe 2 million or 4 million in the aggregate. And depending on the size and the potential risk exposure you have, those may not be sufficient limits. And in that instance, you would look to explore the options with an umbrella policy, because oftentimes you can get additional limits of up to 5 or 10 or sometimes even larger limits. The umbrella policies are typically follow form. In other words, they incorporate the language of the policies that they sit over. So if you have a claim where someone was injured and is bringing a bodily injury claim against the HOA, and the limits of the GL policy are not sufficient to cover the loss, the GL policy would pay out, and then the umbrella would step in and pay the additional loss. But essentially, they would follow the terms and conditions set forth in the general liability policy. Another policy that's really important and is oftentimes overlooked is a directors and officers policy. And this really is designed to protect not only the association, but the directors and officers, the people who sit on the board and who are making the day-to-day decisions regarding how the association is going to operate when things come up, making sure you're complying with your bylaws, your regulations, and your rules. And the easiest way to think about this is think about it as a commercial litigation policy. Again, it's going to protect you in the event that third parties, whether they're homeowners or people outside the association, bring a claim against the board itself for a variety of different things. And when we get into the claim scenarios, we'll talk about what are the most common types of claims HOAs see under a directors and officers policy. Again, it's designed to cover wrongful acts, which is broadly defined as errors, misstatements, acts, omissions, neglect or breach of duty committed by a director or officer in his or her capacity as a director or officer sitting on the board, or by the association itself. It contains 3 different coverage grants. Won't get into the details of those, but suffice it to say, if a claim is brought against an individual for actions they took as a member of the board, there's going to be coverage under that policy for that individual, as well as for the entity itself. It's really going to depend on how the outside entity is bringing that claim. Typically, these policies provide defense cost coverage, and there may be some indemnification coverage depending on the type of claim that's being brought and the relief that's being sought by the plaintiff. When we get into the claim examples, you'll see that oftentimes the most common claims that are brought against a board member, an HOA, the person bringing the claim isn't seeking any monetary relief. They're challenging an action that the board took, and they want the board to change that action. So while the most important part of that would be the defense cost coverage, because the plaintiff wouldn't be seeking to recover any monetary damages, there wouldn't be any indemnification coverage there. But again, it would depend on the nature of the claim being brought and the type of damages being sought by the plaintiff. Another really important policy, again, that's often overlooked by HOAs is a commercial crime policy. And again, this is a first party coverage. So where the association or its members suffer a loss, the policy is in place to reimburse them for that loss. And there are a number of different coverage grants contained in a typical commercial crime policy. But the most common ones that we see in the HOA context is when there's employee theft. And oftentimes, as the association, you are collecting dues, you've got a dedicated account, you are paying out vendor invoices and other expenses. Oftentimes we see the board member who is in charge of running that account may abscond with the funds or set up a scheme to siphon funds out of that account for their own personal benefit. This policy is designed to basically protect the association in that situation where you do have an employee theft and there's loss of money, securities, or other non-tangible or tangible property to the association. And so you can see the common coverage grants, the one I already talked about, employee dishonesty, but there are some others that come into place, particularly computer fraud, funds transfer fraud, and some other things. The process that you go through when you have a claim or a loss under this policy is a little different than other policies in that you're actually filing what's called a proof of loss with the carrier. And it's a fairly simple form, but basically you're identifying this is how the loss occurred, this is the amount of the loss. It's a signed statement that's notarized, and then the carrier will do their investigation. One of the other significant coverages that has now, say now, probably within the last 10 or so years, that has been added to most of these commercial crime policies is something called social engineering loss or invoice manipulation. So as an association, as I said, you are paying various outside vendors. You may have someone who's coming in and responsible for cleaning the common areas, doing maintenance and repairs, etc. A social engineering claim happens when an outside entity, we usually call them threat actors, um, somehow can get into your system or the vendor's system. And in the typical scenario is you'll get an email from the vendor that you know that you have an invoice due for saying, we've changed our bank. Here's our new banking instructions. Send the money for the outstanding invoice to the new bank. And you don't think twice about it. You just go ahead and send it. And it turns out that it was a fraudulent bank account set up by the threat actor. And the intended recipient, the vendor, never receives the funds. You still have an obligation to pay them. And so the social engineering coverage under the crime policy would then reimburse you for that loss. Other potential policies that HOAs will look at and oftentimes buy, but again, a lot of this is going to be dependent on what your budgetary constraints are, an employment practices liability policy. And there's really two parts to this. If there are actual employees of the HOA, and they are their employment is terminated and they bring a claim for discrimination or harassment, or unlawful termination, the policy will kick in and provide a defense for the HOA and also indemnification coverage in the event that that person is able to recover monetary damages. There's also a component to the employment practices coverage for third-party harassment and discrimination. So someone outside who's not an employee brings a claim against the HOA for some type of discrimination, but the policy would kick in and cover that. Another policy that should be thought about and looked at is a fiduciary liability policy. And this really comes into play if as an entity, you were to have employees and you were to offer certain employee benefits, most commonly some type of 401k plan, and you were responsible for administering that. If there were any issues associated with mismanagement of that plan, the fiduciary liability policy would come into play. And then finally, and perhaps most important, particularly in the current environment, is you should be looking at and considering a cyber policy. Most HOAs, you accumulate and you're hanging on to a lot of data. And it's not uncommon for the threat actors to be able to breach your system and get in and get access to that data. The amount of cyber claims that we've seen in the last 15 years has really skyrocketed. And what we tell our clients right now is really it's not a matter of if you're going to be compromised, it's a matter of when. And so a cyber policy, again, is a first party coverage type policy that will afford you coverage in the event that somebody gets into your system, locks your system up, encrypts everything. You may have to pay a ransom to get a decryption key to be able to get back to your system. If they pull data out of your system that contain personally identifiable information, you may have notification obligations under federal or state law. The policy would cover that. And then if that information was particularly sensitive and you needed to pay a ransom to make sure that the threat actors weren't going to take that information and publish it on the dark web or sell it to others, the policy would afford coverage for that as well. So these are really, again, the ones that we talked about, the master property policy, the commercial general liability and umbrella policies, the commercial crime policies. Those are really policies that every association should have. The other ones, the employment practices, fiduciary liability, and the cyber, they're certainly nice to have. And I would strongly suggest if you don't have them, engaging with your broker or agent in a discussion to see, if you have those exposures, if it makes sense to purchase one of those policies. A couple of key issues that I just wanted to touch upon that cut across all of these policies, and really kind of get to, other things that you should be thinking about as an association is, again, one of the questions that was posed is, what are some of the common gaps in coverage that you see from an HOA perspective? And it really varies, but what you should be doing on an annual basis, if you don't already do so, is sit down with your broker or agent and talk about any changes that have happened in the previous year with respect to the association. And are there any new risks or exposures that you believe you may be subjected to? And if that's the case, you should be engaging in a discussion about what insurance products are available that would help you, or afford you coverage for those risks and exposures. But with respect to, the most common thing that we see where, their problems can be created are with respect to appropriate limits. And again, this really gets back to, in my mind, number one, the master property policy is you really need to make sure that the values that you have, with respect to the properties involved, are current and accurate and up to date, because that's going to drive, if you do have a claim, that's what's going to drive how the carrier responds and the amount of recovery that you may be entitled to. You need to make sure that you have appropriate valuations. With respect to the commercial general liability and umbrella, we'll have a specific claim example that addresses this and talks about an HOA that didn't have sufficient limits and they had a significant claim and what the result was. But in the current legal environment and the types of settlements and jury verdicts that we're seeing, particularly in bodily injury claims, you really need to sit down and thoughtfully think about what limits should you be getting. And really, if you don't have an umbrella policy, you really should consider getting one. With respect to claims under these policies, there are a couple of issues that we routinely see that kind of trip up policyholders. And the most important one is reporting claims early. If you know you have a claim, don't sit on it, don't wait. Reach out to your broker or agent right away, or contact your insurance carrier right away to let them know about it. Let them get involved early on, get an adjuster assigned, and start doing the investigation to help you. And this is the same whether it's a first-party policy or a third-party liability policy. And the importance of timely reporting a claim really comes into play, even more so on a policy like a director's and officer's policy or an employment practices liability policy, which are what are called claims made policies. And they're different from a property policy or a commercial general liability policy, which are occurrence policies. And by that, I mean when the actual loss happens under an occurrence policy, the policy that was in place at that time is the policy that's going to respond. So for example, a bodily injury claim, you could have the injury occurred today, but that plaintiff doesn't bring a claim against the HOA until 2 years from now. The policy that was in place today would be the policy that would respond. Claims made policy is different in that the policy that's in place when the claim is being made is the one that's going to be triggered. And claims made policies have even tighter notice restrictions than occurrence policies. And oftentimes, if you're late in reporting the claim, the carrier can deny coverage for late notice. So it really is imperative that when you do have a claim or you're aware of circumstances that could lead to a claim, that you're reaching out to your carrier and letting them know. And this also ties into oftentimes you may think that, well, let's get an attorney involved, see if we can get it resolved because we don't want to report the claim yet to the carrier because we're concerned that if we report a claim, it's going to impact us when it comes to renewal. And Jason will talk about some of that stuff in a minute. But it really is a problem if you start doing that because carriers are not going to recognize any expenses that you incur before reporting the claim to them. And furthermore, if you try to resolve a claim before you've reported it to the carrier, they may take the position that one, there's no coverage at all, or two, if you have a deductible on your policy or a self-insured retention, you've just increased that by the amount that you offered to the plaintiff to try to settle the case. And then finally, I would just say with respect to claims in general, it's really important that you document everything because whether it's a first party claim or a third party claim, once the insurance carrier is involved and adjuster is assigned, they're going to be doing an investigation and they're going to be trying to gather as much information as they can in order to, one, assess coverage, and then two, to understand what the potential exposure is going to be. And it's so much easier for that process to run smoothly if you've taken the time to document things and preserve any evidence that might exist relative to any particular claim. And with that, I will hand it off to Jason, who's going to talk about the state of the market and underwriting considerations.
All right. So state of the property and casualty insurance market. I'm sure all of you are aware it's been a very rough couple of years. Unfortunately, there's some improvements, but it's still definitely tough sledding. We're still dealing with limited carriers and capacity, particularly for property. Excess capacity is limited. Carriers are underwriting the lead 5 million extremely carefully. There's several reasons for this. Probably the biggest is reinsurance costs. So reinsurance is the insurance that insurance companies buy, essentially. So over the period of 2018 to 2023 in the U.S., premiums doubled for reinsurance, and they've steadily gone up since then. On the property side, it's really just due to the sheer amount of frequency and severity of natural disasters. And those reinsurers are participating in paying claims far more than they're used to, and that price is just trickling all the way down the market to the consumer. And then on the casualty side, we're dealing with what the market's calling social inflation, which is essentially litigation out of control. I don't know if you've heard of the term nuclear verdicts, but we're essentially seeing verdicts much larger in these past 10 years than we've ever seen historically. So that's why that lead 5 excess layer is being underwritten very carefully because it's the first to get pierced. And carriers are paying more in excess claims than they traditionally have. On the property side, we're seeing a little stabilization. So when inflation hit, every carrier combed through their entire property book and overnight increased their values. They felt all their values were grossly undervalued. Most of the time they were accurate, but at the same time, they were also increasing rates and deductibles. So it was a nightmare. Most carriers feel good where they're at from a value standpoint and from a deductible standpoint, but they're still getting rate. So associations with favorable loss history, and they're looking at a 5-year clip. Should have more options at renewal, and it should be better. So really 10% or less is kind of what you should expect on a clean account. If you have suffered losses, especially in the 21 freeze, you might still have a year or two of seeing some increases potentially in deductible and rate and still not have as many options come renewal. Next slide. So there's several factors driving this market view. In Texas, a huge issue is that the 19 and 21 freezes. That water damage was really not on the radar of insurers and reinsurers, and it became a huge issue overnight. So those claims, wind and hail has always been a big issue, of course, in Texas, but water damage wasn't. So it just kind of added to the already tough market we were dealing with. And of course, still carriers are very concerned with convective storm. So that's windstorm and hail. To the point where a lot of carriers are looking at their aggregation in certain areas. So say take a county, Collin County, they want X amount of values there. And once they exceed that, they're going to start to non-renew. So we're seeing that. So you may experience that. There are more options in the property. So don't panic if that happens, but we are starting to see that. GL is starting to stabilize. There's some more carriers have entered the market. So that's a positive. DNOs remain stable. There's a little hiccup when COVID hit in 20 with all the uncertainty, but it shored up quickly and it's remained pretty stable. Still unforeseen how the California wildfires will affect the market. Obviously, it's far from here, but a disaster of that event will affect the market. I saw yesterday, I think to date, there's been $7 billion paid, anticipating between 8 and 40 billion, which is a huge event, but time will tell how much it will impact the market. In Texas, we sustained 4 severe storms and 1 tropical cyclone in 24. So unfortunately, the frequency and severity of natural disasters continue to pose a threat. So underwriting considerations. So more than ever, it's important to stand out to underwriters if you're needing to go to market. So underwriters are being inundated with submissions. Everyone's hitting the street for the same reason, trying to find better options. So really, it's your broker's job. Work with your broker to put your account at the top of that underwriter's list. A big thing right now with properties, the age of building. So really, any building over 25 years. Most of our carriers right now won't quote unless there are updates for all of these components here. So to roof, wiring, HVAC, plumbing, heating. So keep an accurate statement of values, including updates. This will just help you if you have to go to market. Do you have that information readily available? And if you need some updates in some of these areas, you may want to look into investing in that now. Implement a plan for winter weather freeze protection. This is brand new to Texas, and this goes back to the issue with the 19 and 21 storms. Every supplemental application is going to ask you, what's your plan? Typically, they'll have some questions, pretty obvious what the answers to be, but every carrier is looking at that very carefully. Consider implementing water detection sensors. We have several carriers that are offering that for free now. If they are, I would take advantage. If not, they're not very expensive. You can get them at Home Depot or Lowe's or really anywhere. For associations that have suffered potentially preventable claims, make sure that you've identified what's been done to mitigate the future occurrence of the same. That really just helps us sell the story to the underwriter. If you've had a claim, just tell it. That goes a long way. And knowing what's been done to mitigate. File claims timely, going back to what Aaron spoke about previously, and really from a marketing standpoint, you're viewed as a better risk if you're doing everything the right way. More than ever right now, be proactive with carrier loss control recommendations. It just shows cooperation and partnership, and when it comes time to quote your account, it goes a long way with the underwriter. One more thing I would add is from a strategy standpoint, it's always best to choose one broker, interview as many brokers as you want, and let them go to the market. It just causes uncertainty when you have multiple brokers going to the same carriers. If there's different information, they start to get leery. So choose. You'll have the best results if you do it that way.
Jason, before we move on, I mean, a question I get a lot is, from our clients is, well, how is the carrier going to view me as a risk if I file a claim? And so, we have this conversation, and the client is wrestling with, well, aren't I better off, particularly if it's not going to be a big claim, aren't I better off just, paying it myself and not tapping into the insurance? And of course, our advice is always, well, you purchased the insurance for a reason. You should use it. When claims are filed, particularly when they're paid claims, how do the carriers view that?
They want you to report the claim, even if it's a notice only. Yeah, they want to know. So in case, because you never know what a claim could turn into also. I mean, they have to, especially if it's a liability claim. So it's more importantly for liability, I would say report it because you never know what it could turn into. And they view that as partnership and cooperation.
Yeah, I often, oftentimes we'll have a situation where there's a claim and, we ask or we talk to the client and say, don't view this as a negative. Sometimes it can be a positive. It's an opportunity for you where you were talking about, selling yourself to the market. It's an opportunity for you to put a positive spin on things and say, yes, we know we've got this claim. However, we think it's defensible. Here were some of the actions that we took, to mitigate the risk. And it just so happens that, this fact pattern occurred or whatever. But oftentimes it is an opportunity to let the underwriters take a little bit more of a peek behind the screen or the curtain, if you will, and see as an association how you actually conduct business, how you handle things. And it may turn out that they view you as a more positive risk, even though you've had this claim that you've reported.
100%. Yep.
So with that, we'll move on to the last part here and talk about some claim scenarios. I talked about it a little before, and Jason, mentioned nuclear verdicts. And just to kind of give you some context, nuclear verdicts is a phrase that's been out there now for a number of years, and it's generally considered a jury verdict in a most likely a bodily injury case of $10 million or more. There is now talk of, well, I heard it for the first time a few weeks ago, thermonuclear verdicts, but the amount of nuclear verdicts has gotten so frequently, or has gotten so frequent and has so increased in the last few years that either one, there's kind of a consensus that we're going to amend the definition of nuclear verdict and move it up to something about 50 million or more, which again just boggles my mind. Or this term thermonuclear verdict is going to catch on. But all that is to say, you have a very aggressive plaintiff's bar, and a whole bunch of factors existing out there that you have no control over as an association. We have what's called social inflation, where people just think that if you're the defendant, you did something wrong, so they need to award money to the plaintiff to punish you. The value of the dollar is really not recognized anymore. Plaintiffs' attorneys really have a number of different ways to bring these cases to trial, and the stories they tell and the way that they actually present the case to the jury to kind of inflame the passion and prejudice of the juries to the point where they come back with these significant dollar awards. So you've got all of these things kind of coming into play, which is resulting in these significant jury awards. And this first claim example was an actual, claim. It wasn't one for a client of ours, but it was a fairly common situation where you had a person who's on HOA property was injured, and in this particular instance, they were injured by a poorly maintained swing set and unfortunately sustained a traumatic brain injury. So when you have a claim like that with significant damages, there is no question that the plaintiff's attorney is going to get hyper aggressive and demand significant amounts of money for their client. And in this case, litigation ensued, and the plaintiff sued both the swing set manufacturer and the HOA. The case went to trial. I believe the swing set manufacturer settled before the case went to the jury, but the HOA didn't. And the jury returned a verdict of $20 million and allocated a significant portion of the fault to the HOA because there was evidence presented at trial that the HOA knew the equipment was deficient, and yet they neglected to pay for a maintenance plan recommended by the installer of the swing set, nor did they provide their own maintenance for the equipment. So essentially, they knew it was a dangerous situation and they took no action to abate that dangerous situation. And as a result, the jury allocated a significant amount of percentage of the fault to the HOA. In that instance, they had a GL policy, but it only had 2 million in limits and they had no umbrella policy. So at the end of the day, their carrier paid the 2 million in limits and said, we're out. We don't have anything else to offer you here. The limits are exhausted. And the HOA was responsible for the remainder of that verdict. And think about it. I don't think there are many HOAs out there that are going to have those additional kind of funds on hand to satisfy a verdict like this. So as a board, how do you deal with this? What are you going to do faced with that type of situation? And it's not a good situation, not one you want to be in. So again, this claim example, I think, really drives home the point of, if you don't currently have an umbrella policy, you really should talk to your broker about, exploring getting one. I'd also mentioned before, directors and officers coverage, and well, these aren't kind of specific claims examples. They are the most common types of claims that we see being brought against either individuals or the association itself, that the directors and officers policy is going to respond to, and at the very least provide some defense cost coverage for. So board action disagreement, that's simply where, as members of the board, you make a decision and your members aren't happy with it. And they don't like the action you took, and they sue you to try to get a court to overturn the action you took. A breach of fiduciary duty. You are mismanaging or misallocating association funds, and they sue you for that. Architectural request denials. These are fairly common too, where an owner wants to make some change, and as the association board, you say, no, the changes that you've submitted to us, or the proposed changes, aren't in compliance with our rules and regulations, and therefore you deny the request. That's going to entail, more often than not, subsequent litigation. Violation issues. If someone is not paying their association dues on time and they get fined, or whatever the violation may be, oftentimes, even though there may not be any validity to their claims, association members are gonna bring a lawsuit just to try to short circuit that whole process and get the association to back off from levying those fines and penalties. And then another real common one is pet issues. We see this now come up most frequently, where someone has a service animal, and they make a request to the board. If there are significant limitations on pets within the association, they say, hey, well, you have to make an accommodation for me because this is a service animal. I've got all the appropriate documentation to support that it's a service animal. I need this for my own health and well-being. Request is denied. You're going to have litigation ensue. So those are typically the claims brought from members. And there are others as well, but those tend to be the most common. There also, though, can be claims brought by outside entities. And the most common we'll see is an outside vendor comes in and does some work for the association and doesn't get paid. So they're going to sue the association for non-payment of their invoice. More often than not, if there was a contract in place, they'll sue for breach of contract. If it wasn't a contract, they'll just sue for non-payment of services provided. And again, the D&O policy is going to respond in that case to provide a defense, and depending on the particular circumstances, may also provide some indemnity coverage. And then I kind of wanted to finish with some a couple of claim examples under the commercial crime policy, and one of them is really going to employee theft, and then the other one is going to involve social engineering that I talked about a little bit earlier. But a real common situation is this employee theft where a property manager, built up a number of HOAs in their portfolio. In this case, the individual was in charge of all of the financial operations under his management, including collection of dues and payment of expenses. And as we often see in this, kind of claim scenario, they had a significant gambling habit, or oftentimes it could be an addiction issue where they need cash, and a lot of cash in a short period of time. In this instance, this individual had a severe gambling habit, and he began taking money out of the HOA accounts, fully intending to pay it back, but was never able to do that. And when the losses were finally discovered, the various associations were out over $1 million. Thankfully, the associations that had purchased a commercial crime policy were able to make a claim under those policies and were able to recover their losses and be reimbursed. In that scenario, there were a couple that didn't, and they were just out the money. The option they had was to pursue the individual themselves, but more often than that, that's just not going to be a fruitful endeavor, because the individual who perpetrated the theft in the first place isn't going to have any assets by the time you are looking to try to recover. Social engineering, as I talked about before, the most common situation we'll see is that invoice manipulation or changing of banking instructions. And one of the things that I failed to mention before is, while this is a very prevalent coverage in a commercial crime policy, for many carriers right now, this is their loss leader. They're paying more money out on these types of claims than any other type of claim under other policies that they issue. So there really has been kind of a restriction of this coverage, not necessarily in terms of the types of losses that these policies will cover, but really the most carriers now will sublimit the amount of coverage you can get for social engineering. So most commonly now, you're going to be limited to either 100,000 or 250,000. In some cases, you might be able to get higher limits, but those are really the most common right now, 100 or 250. So you can imagine a scenario where you have a situation where you have multiple vendors that you are going to pay. And if someone gets into your system and changes the banking instructions for all of those, you certainly could have a loss that might exceed those limits. But more often than not, when we see these claims occurring, they involve a single transaction. It's caught early in the process, but for whatever reason, the banks are not able to recover the money. But typically, that loss is going to fall, within the applicable limits. But again, I can't emphasize enough right now, from my perspective, and working with our clients on claims, and my the other claims advocates that I work with who are on my team, this is by far and away the most frequent type of claim we're seeing right now are social engineering claims. And with that, I think we'll open it up to any questions that came
in. Okay. Well, our first question is, I've heard about AI risk assessments. What is this, and is it relevant in today's market?
So, I can speak to that a little bit from the claims side, and in talking to various carriers and third-party administrators who handle claims for carriers, we're starting to see them use AI, and they're going to use it more and more. I don't think it'll get to the point where it will replace the claims adjuster role and the kind of the human element of that, where an adjuster is doing a coverage evaluation and investigation, relying on their own experience and knowledge base to assess, what the risk is, setting appropriate reserves. But we are seeing entities starting to use AI more on kind of what we call administrative tasks, getting initial information from the claimant, helping set up claim files. I think there are some TPAs who use an element of AI to help in their reserving process. It's just a tool. It's not the end all be all in terms of the adjuster just plugs information in and the number is spit back out in terms of what they should be setting the loss reserve at. Honestly, I don't know, Jason, if you've had any experience with underwriters using this.
No, I haven't to date, but I'm not going to be shy. I mean, it's entering every aspect of life and business. So kind of time will tell. Really not a big impact at this point, but it's starting to creep in for sure.
Yeah. I think from an underwriting perspective, there still is always going to be heavy reliance on the actuarial analysis that the carriers do in terms of assessing the risk, looking at prior losses, trying to do some predictive modeling to think about what future losses may be and how they set rate and where they come out at premium. And again, there may be some element of AI where they're using it as a tool, but I just don't foresee in the very near future anyway, where that kind of human element of that actuarial analysis is going to go away and be supplanted by pure AI.
Our next question is, if you have a management company for the HOA, shouldn't they hold the cyber policy, or should it be the HOA specifically?
Yeah, it's a really good question, and it kind of depends on the nature of the relationship that you have and the contract you have with the management company. The management company for sure is going to have a cyber policy, and if the way that they operate, if they're willing to have the association as an additional insured on their policy, and the carrier is willing to do that, that's probably a good option, because the management company is probably going to be in a position where they're able to procure a policy that's going to have higher limits, which is going to afford more protection. Whereas if you're an individual HOA and having to go out and get your own policy, it's going to obviously be a much more significant cost to try to get higher limits. But again, I think that's really going to be dependent on the nature of the business relationship between the management company and the HOA.
Okay, and then we've got another question. Are there any emerging insurance products or alternatives that HOAs and condos should consider in 2025?
There's really not any particular products. There's some, like I mentioned earlier, some new carriers and their way they're rating differently. I mean, back to AI, there's a lot of online portals and stuff that are emerging in the market. Captive insurance is something that is an option, but it would be for larger associations. Their minimum premiums are typically 100 grand to 250. So that is a potential option. And what a captive is essentially, you are the insurance company. So there's group captives and there's single parent captives. Most associations would fit in a group captive, but like I said, it's really for larger risks. So it could be an opportunity for some associations, but probably not for the majority.
Okay, great. And then our final question is, are there any resources you can offer that will help us to educate our owners on the current insurance market so the heat can be taken off the board?
Well, you can bring your broker out. We're used to taking arrows and used to being disliked.
I would say, and this is slightly off topic, but as the board, if you don't overlook the fact that your insurance carriers want to be considered partners with you. And so most carriers are going to offer a lot of resources and educational materials and other things to their policyholders. Oftentimes, if you look at the actual policy that you receive, one of the initial pages, they'll have a portal that you can register as one of their insureds, and then you can get into this portal. And depending on the type of policy, if for example, if it's a cyber policy, there'll be resources in there where you can talk to a cyber forensics expert if you have questions about system vulnerabilities. They may have options for you where they can come out and do some testing on your systems. For employment practices liability, oftentimes they'll have a ton of information about employee handbooks and other templates that you can access and use. If you have a question regarding an employment issue, you're thinking about firing someone, but you're concerned that you might get sued. Oftentimes those carriers will have lawyers that you can talk to that will give you free legal advice up to a certain point in time. So don't overlook your carriers as a significant resource to help you. Again, they've put a lot of money and time into these resources, and they love it when their policyholders avail themselves of that, because that tells them, one, that you're a good risk. You take this stuff seriously and you want to engage in behavior to mitigate the risk and mitigate the subsequent loss. And so oftentimes, I mean, when I was at carriers, we had all this stuff, and we did not monitor, policyholders who went in and looked at that stuff and used those resources. But oftentimes on the claim side, when we had a policyholder that submitted a claim and we were talking to them, that would be one of the things that we'd ask them, hey, were you aware that this was available? And oftentimes say, yeah, we went in there and looked at it. It was great. So there's a ton of information and resources available from the carriers, and you absolutely should take a look at that and tap into it if you do have it.
Yeah, it's huge when we market the account too. They want you to use them, and if you are, you're viewed as a much better risk. That's a huge point.
That's really, really good to know. And I think that's a great way to end that, there are resources out there, and take advantage of those. I think insurance continues to be one of the most misunderstood areas of HOA for board members. And this has been very, very informative. Thank you so much, Aaron and Jason. We really appreciate your being with us today and educating us on so many important facets of insurance and what should be considered as you're renewing policies. So thanks so much. Everybody have a great day, and we'll see you next month.
Thank you.
Thanks.